The last 9 months have seen a interest rate increase month in, month out, and this is unprecedented. There hasn't been a time in Australian financial history where interest rates have risen so fast and so hard. And the number one question I get from my clients is, well, where's it going to end? Will interest rates keep on going? And most importantly, how do I prepare for it? The quick answer is probably to discuss what has led us to this point. Too much liquidity given by government during the COVID crisis, the Reserve Bank dropping interest rates to historical lows to get people to spend, and then the failure of government to tie in the liquidity, running continual deficits, and also the Reserve Bank keeping interest rates down for too low, so for too long. So coupled together has meant there's been too much money in the system, plus the supply problems with everything from energy, fuel, food, and also employment has led to a coming together of a calamity of too much liquidity. Prices will rise, and the government's got to slow it down. Unfortunately, there's only one lever the Reserve Bank can use in these kind of crises, and that is interest rates. They make a decision on the first Tuesday every month. They use figures from the ABS, the Bureau of Statistics. They use unemployment figures. They take into account the CPI, the Consumer Price Index, which is how they judge inflation. And from that is the basket of goods. They go into the CPI, which includes grocery bills and groceries and fuel and other expenses. And in the last 9 months, they've come to a conclusion, or the 10 months, they've come to a conclusion that they have to keep on raising interest rates to slow down the economy to get people to stop spending. Unfortunately, only 1/3 of the Australian households have a mortgage. 1/3 has got no debt, and the other 1/3 pay rent. So that means that all the responsibility at the moment is falling on one demographic, and that is those families who are paying a mortgage, and that is usually a demographic between the ages of 25 and 55. It's usually the demographic that's got the least amount of options when it comes to the amount of expenses they can cut back on, and the least amount of options to increase their income. So what does this mean to the normal household who has got a mortgage? It means that you've got to listen. The Reserve Bank is out to punish you. They want you to stop spending. So you need to make some hard decisions, and you need to make them really yesterday so that tomorrow is not going to be as severe.